The Ensemble podcast is intended for professional financial advisors. This content is created in partnership with our sponsor, Zurich Australia Limited, ABN 92 000 010 195 AFSL 232 510, and is limited to publicly available information. Before acting on any general advice, you should consider whether appropriate and obtain financial advice from a qualified financial advisor. Ensemble does not hold an AFS license and does not provide any financial advice or services or endorse any general advice. If a PDS or IM exists, you should obtain a copy and review it thoroughly before making a decision.
Welcome to the Life Insurance Podcast for Ensemble. I'm your host, Ben Donald, Managing Director of Life Advice Partners and currently completing a doctorate in life insurance. My goal is simple: improving life insurance outcomes for Australians. This podcast series is all about bringing life insurance back onto the radar for advisors across the country. Each episode features real conversations with the people who live and breathe this work every day, uncovering the lessons, processes, and the stories that help advisors lift confidence, capability, and client outcomes. Whether you write 2 policies a year or 200, this podcast is here to help you deliver better protection, build stronger businesses, and ultimately serve more Australians. Let's jump in.
Zurich is proud to be supporting this episode. Experience Zurich and OnePath advisor portals with new and improved digital capabilities and an enhanced range of self-service functionality, helping make your business more efficient, saving you time and removing complexity. It's everything you need in one place. Partner with us today.
Hi everyone. With me today we have Jack Standing, who is Group Head of Advice for WT.
Correct.
Mate, welcome to the show.
Thank you.
Mate, can you tell me, start off with WT, right? You're a huge organisation. I think it's 100,000 clients. I was reading on the website you do 25 million in new business premium. I don't know how many billion in FUM, but I'm guessing it was a lot. Mate, can you just take me through what does WT look like today?
So we're an advice network of about 550 odd advisors across 350 practices there or thereabouts, which ranges anywhere from single advisors with zero admin or sort of back office staff all the way through to much larger, more corporatized advice models. We have a very diversified range of practices. So there's a whole variety of different specialists across aged care advisors, risk specialists, all the way through to comprehensive or holistic practices where they're sort of everything to everyone. From a risk perspective, we have an in-force insurance book of about 450 million.
Choice.
New business premium about 25 million a year. So it's a pretty big part of our business. I was looking at the numbers earlier, and over the past 12 months, out of the new client advice that's been provided in our network, of that 40% of them had some form of risk advice in it. So,
wow.
I know across the industry, the numbers are 5% of advisors, right? 50% of new business premiums. For us, we've got quite a few specialists in our network, but still a reasonable amount of the holistic advisors or non-specialists still actively participate.
40% isn't reasonable. That's huge. That's great, mate. Well done.
Thank you.
Yeah, that's fantastic. Mate, but again, I did a bit of snooping on your LinkedIn quickly, mate. Spring Financial. I saw something in there that you were head of medical at one time. What can you help me understand that?
Yeah. So look, my role in our business has changed a hell of a lot. So it's been around for 15 years. It's essentially been WT Financial Group for about half of that time, so 8 years. It started as a self-licensed advice practice on Spring Street, ergo the name Spring Financial Group. I joined about 2 years in, so 13 years ago, as a graduate financial advisor. Wouldn't meet the education standards today to be able to commence a professional year, but at the time, thankfully, it wasn't as strict. So graduate advisor, we ended up building that business to about 70 staff, 2,000 client households. We had 20 salaried advisors, like full-time salaried advisors at its peak. So it was a pretty sizable business. Multidiscipline. So we did everything from mortgage broking and accounting through to all aspects of fin planning. So retirement planning specialists, lots of superannuation, self-managed super funds, insurance, estate planning, essentially everything. And I went from being a grad advisor. I was hired out of Sydney and punted very quickly down to our Melbourne office. Got brought back to head up the medical specialist division within the business. So we acquired a company which was at the time called Pink Diamond Financial Group. It was Flowers Financial Group, if you recall the name from back in the day. Thankfully, it changed a little bit along the way, but it was to head up the team. So we acquired the clients, we acquired the staff, and it was essentially a subset of the advice business that specialised in dealing solely with medicos.
Yeah, wow. So when you say head of medical, I was worried you were a doctor or a nurse, and yeah.
Unfortunately, not. No, don't have any of that capability in me. But no.
Yeah. All right. And so then Spring somehow got into WT, and I know WT's grown like exponentially over the last while.
Yeah. So we made a conscious decision to. I mean, I think anyone that's heard Keith say anything for any reasonable amount of time, he has this phrase about running into the burning building with a bundle of cash. And so when the Royal Commission was sort of starting to heat up and all of the major, or certainly the majority of the major advice networks at the time, other than really AMP and now Insignia, were signalling their exits and figuring out how they could, sell their loss-making distribution advice networks. We saw a massive opportunity to go into that space. And so we started selling down the components of the advice business that was there. And we had some salaried advisors that acquired sections of the client books in other cities and regions. And some of them are still authorised reps under one of our licenses now. But basically we just saw an opportunity to go and hopefully do what we thought at the time was going to be do the fun stuff, which was, help advisors build better businesses, price themselves properly, monetize their professionalism and expertise, help them market, sell well, all that sort of stuff. We ended up making an acquisition in 2018, I think it was initially, which was Wealth Today, which was a Perth-based advice network, which I think had about 40 advisors at the time. And so most of those advisors were what we affectionately sort of call advice as a second language. Most of them had sort of started being accountants or mortgage brokers and gotten into advice. Some of them had already decided to sell off their mortgage books and advice was going to be the business, but it wasn't really where they started.
Right.
And many of them were startups. And some of them were still in the very early stages. And so we became very comfortable with dealing with startup practices that had minimal clients. And a lot of that was, a lot of the time spent initially was in helping them grow and build those businesses. We ended up doing a series of other acquisitions along the way. Century was the next one we did. And then about 6 months after that was Synchron. And the last one we did was 2.5 years ago there or thereabouts, which was Millennium 3. And so that's how we've ended up with the size of the network that we have. And the, better part of 3.5 years was largely about integrating 4 disparate businesses that were either cash flow neutral or losing money into a business today, which looks very different and thankfully is quite profitable.
Yep.
And we've got a really engaged network of advisors that are doing all sorts of awesome stuff.
Mate, that's brilliant because going through that time, as you say, pretty much every licensee was losing money, and you're a publicly listed entity. So, everyone knows that the growth has continued. Yeah, correct. Right. Continuous disclosure's got that impact.
Yes.
It's, so your role must have changed quite significantly. It's lovely to hear that you've come from an advice background. And so there's, you've got that experience and now it's a leadership component across the whole group. Now, you mentioned the WT going from, here to here, or Spring, originally, and now you're really, really sizable and 40% of the advice coming through WT is about life insurance, which again, mate, music to my ears. How does the scale and the size of WT, what are you doing with it? How does that translate into, I guess, relationships with insurers, benefits to the advisors? What does that look like?
So I think, particularly from a risk standpoint or risk advice standpoint, I think scale is very important. Now, I mean, that can play out in a whole bunch of different ways. Certainly, relationships with insurers when there are difficult situations that can arise that are able to benefit the practices. It's also an inherently risky thing to do, provide risk advice. Now, advisors, actually anyone that's operating in financial services is in the business of rating, pricing, buying and selling risk. And so if we think about whether you're an insurer, whether you're a platform, whether you're an advisor, a fund manager, that's all we do. And so the idea of risk existing is neither bad nor good. It's just either priced correctly, right? Or not. And so the ability for a larger network to bring that sort of size and scale and significance to bear when push comes to shove can be really valuable to help protect advisors and obviously their clients. I think the other side to it, and I think this is a key part, is we run a whole bunch of different programs within our education program. And the idea with it is we want as many of our advisors and the practice managers and their support staff to get involved and engage within all of that stuff. And so if you think about the nature of being an advisor by and large, it's a cottage industry and most of them are, by themselves. They sit with two other people and, the person that sits by themselves has their own good ideas. And the person who sits with two other people has maybe good ideas and bad ideas of three people. The big benefit of being in a large network where you've got scale and, the balance sheet to be able to arrange and facilitate these networking opportunities is for the sharing of really good ideas. And so we say it all the time to our practices, we don't have all the good ideas. Absolutely we don't. But we steal them off our practices all the time with the intention of sharing them to the other advisors in the network with full credit and full disclosure to the guys and ladies that came up with them. But it's really important, whether it's efficient processes, whether it's how to market and generate leads in the right way, whether it's to build efficient and repeatable insurance philosophies, pre-assessment processes, all of that stuff comes with the benefit of scale and resource.
Yeah. And I guess marketing, look at the ice bucket challenge that you guys held on the island there.
I think I lasted about 30 seconds.
Yeah.
If that was fully red when I got out.
Yeah. Anyway. You mentioned before about benefits of scale when it comes to the sort of the grey area, right? And as a risk advisor myself, and I imagine every financial advisor is worried, the biggest risk for what we do is when a claim goes sideways.
Yep.
What sort of support are you able to provide your advisors leveraging that scale for the cases that are maybe borderline?
So I think we've seen this play out in real time firsthand. Every advisor that's provided risk advice and has a reasonable in-force book themselves knows that there are claims that are clear cut. There are those that are in the grey, as you mentioned, and then there are others that quite reasonably get declined by insurers for whatever reason.
Very much agree with you, mate. And that's something that is probably missed a lot of the time. Hey, is that insurers do cop probably unnecessarily levels of flack because they're generally pretty good.
And look, exactly. In our experience, as a general rule, all behave really well. There are certain cases where, if you think about it from this perspective, there's a difference between potentially being legally in the right and then there being a commercial discussion or maybe an ethical decision.
Yeah, just doing the right thing.
Be made.
Yeah.
And when you've got an in-force book of, 450 million or with a particular insurer, it might be this. All that matters is what happens at claim time. You can talk about cheaper premiums. You can talk about better definitions.
Yeah.
All that matters is how the insurers
great.
And the policy responds at claim time. And I think just logically, and it's certainly been our experience, is they generally all behave very, very rationally and reasonably within the constructs of of what they're allowed to do.
But when they don't, you knock on the door and go, hey, that 450 million of in-force. Would you like some more or not?
Yes. And it's not unique to us, right?
No,
the practices that write a lot, the networks that have a lot of in-force premium naturally do have different sort of escalation pathways that if not necessarily get a different outcome, but potentially get it quicker.
Yeah.
And for a client who's, disabled, something that's happened in their life, which is not going to be good. Otherwise, we wouldn't be talking about an insurance claim.
Yep.
Speed is of paramount importance.
Yeah. Okay. And what other areas do you sort of lean on the insurers? So you can, not push and shove, but you can throw your weight around when necessary. Generally, it's not with the insurers for claims. But in terms of education, software support, looking at fee models, pre-assessments, all that sort of stuff, what practical capability does WT bring to the table for the advisors in the group?
So we're massive on insurance-specific education.
Yep.
So in our education program, we reserve 2 out of 5 spots at every PD day for risk advice.
That's bang on 40%, mate. That's who would have thought?
Maybe
there's something there.
And 4 out of 8 education partner speaking spots at our national conference.
Yeah, right.
And so we just naturally see it as this, everyone talks about the underinsurance issue being the biggest it's ever been, right?
Yep.
From a commercial perspective, it's just an enormous untapped opportunity for advisors. Now, there are legitimate reasons for some people to not participate in it or have a different approach, but for us, it's a massive opportunity. And so it's one of our 3 core corporate objectives, which is getting more risk advice written in our network and facilitating more proactive referral relationships between those that have chosen for whatever reason not to do it, or maybe they specialize in a particular demographic like retirees, and they every now and then get a 45-year-old that turns up and needs to have a conversation, but it's not really a fit for them. So we have great relationships with the insurers. Almost all of them are sponsors and education partners of ours. Dedicate a lot of airtime to it in our live stream workshops that we do, there's about sort of 60 or 70 standalone sessions. We'll have about sort of 15 or 20 of those will be risk specialist ones. We do insurance product profiles once a month on Wednesdays. This year, there's going to be a hell of a lot of airtime, I think, given to new age TPD products and constructs to help people understand them.
Yeah.
Because the whole idea that it's not commercial is simply not true, as evidenced by the guys that are making heaps of money running risk specialist practices. But it's completely understandable if they're not doing it efficiently, and the first handful of policies they go to submit get declined for whatever reason because they haven't pre-assessed well. First thing is, it's all too hard. And so I think the support from the insurers on the education side is really good. One area where I think that they could do better is, I think I have to be somewhat careful with my words here, but there could be more industry utilities to help support both advisors with in-force books. If you've got a broad book across 8 different insurers, or whatever 6 or 7 different insurers there are practically now, or go and download your the renewals that are coming up across the 7 or 8 different advisor portals, then figure out how you're going to deal with those all together. So there should be a way to be able to deal with those easier and more efficiently. I know Brett at LifeBid's doing some awesome stuff in that regard. Pre-assessments are still a bit of a basket case. We run a dedicated pre-assessment service for our advisors.
Oh, wow.
And so what they're able to do is essentially send a smartphone link out to their clients, which has been built by our good friends over at Zurich. And so it's a smartphone with up to 200 questions. It maps over almost perfectly with their the questions they'd be asked through application and underwriting anyway. So it's capturing all the relevant information, but only asking follow-up questions where
where somebody said yes.
The correct answer was given, or the incorrect answer, if you will. And that's been great to help streamline the advisors to not have to, sit down and go through an application that might get declined or figure out how they're going to do pre-assessment questioning themselves. We'll handle all of the liaising with the
you as
insurers,
in
WT.
Will do it. Wow.
Yep.
Righto.
So Mark Corbin runs that.
Corbo.
I think you
shout out Corbo.
Shout out Corbo. I did tell him I was going to give a bit of a shout out to him. And so he liaises with the insurers. So essentially, other than sending the form out to the client and letting them know it's going to happen, and obviously the initial advice and sale on the insurance up front, is essentially all taking care of them. And they know that based on the pre-assessment response, and we do limit it to 2 insurers so that, there's not 8 pre-assessments being done for one policy, which is somewhat understandably the complaint from a lot of the insurers. But they're able to get, quick and efficient responses, generally within 48 hours from insurers, knowing that, they're sort of one of 2 insurers being considered at that point in time for that policy. But we just need an understanding of, is this an insurable client?
Mate, that's awesome. So I remember I was licensed by Millennium 3 going, 10 years ago or something. And that was tried through an email system that ultimately didn't get much traction. So it's wonderful to hear the development of that has moved into now having a single liaison person. If you take the lesson from the general insurance world, their underwriting is such that now there are underwriting agencies. So whole business is built to basically do what Corbo does. And that's facilitating growth in the industry. So that's wonderful. I'm guessing that makes advice a lot easier.
I hope so. Certainly hope so. Look, I think there's no question improvements could still be made there.
Yep.
So, whether AI is part of that solution or not, it seems logical to me, but, what do I know? But I think also like a reasonable, like whether it's through Cali or some other sort of form, there should be an industry utility that is set up in some form to streamline pre-assessments.
Could not agree more.
Everyone get on the same page on the questions and what needs to be put in there.
Yeah.
You don't necessarily, it doesn't have to be a concrete we will offer on these exact terms. There's always going to be cases where certain things come out at application time that didn't come out in pre-assessment.
There's always an asterisk.
But you're breaking the back of, 80% of policies.
Yeah, mate. It's funny, right? I've had the same conversation with senior leadership of the insurers, and a lot of them are responding to say, no, that's our value proposition. So we'd never sort of blur the lines or allow for a white label. And I guess hearing from the horse's mouth here for myself as a risk advisor and yourself who's in, leading 450 million of premium, that doesn't mean much, right? It's just we want that one form, we want that one underwriting capability that we can talk to every insurer like that.
I mean, look, I haven't surveyed the advisors that
let's just assume it's yes.
I think it's safe that is unlikely to be the competitive advantage of one insurer.
Mate. I think guys like I think so within your crew you've got PJ, Katrina Haskew, Dave McLean, like all of them big risk riders, and I know that they've been banging that same drum. So if the insurers are listening, please start taking note. Every advisor wants this.
Yeah, I'll be listening to those 3 for sure.
Yeah, brilliant. What else? So risk advice, you mentioned before, commercial outcomes, 60-20 is not great. Look, and if I reflect on the leadership from WT, so Keith's a big believer in life insurance. He wrote a great article. What was it? Absent a vision of future, the industry is in runoff or something along those lines.
In the absence of a vision, no vision exists, something like that.
Yeah, right. So anyway, but it's so demonstrating that, the industry needs leadership, and it's wonderful that he's doing what he can, obviously with the FSC, and we'll get to education in a second, but within WT. So practically, again, so we've got the pre-assessment tools within WT, which will speed up new business applications. Is there any education around fees? Charging upfront fees? Or
if you ask any of our advisors that come to our PD days, it would be fair to say that we and in particular Keith and Frank don't shut up about them for good reason. I think. Look, I mean, Lift came and the commission rates that advisors receive from the insurer reduced, and most people just accepted that was all that they were ever going to be entitled to from a remuneration standpoint. And if you just follow that bouncing ball, that's everyone accepting the fact that their value in the market dropped. And that makes no sense when you put that up against the fact that there are far fewer advisors overall and an even smaller cohort that are actually delivering insurance advice in a world where the underinsurance problem has never been bigger. And so like none of those things make sense. So all the economics make sense for risk advisors to be making more money now than they ever have before. And I think, and they're not alone, because there are tons of advisors that either, don't do insurance and they just do, investment and super advice or whatever, or they provide comprehensive advice that still undercharge. Don't charge enough for advice, don't charge anything or enough to implement the advice. And part of it is like they're still stuck in this old world of, investment commissions and insurance commissions. And, that's what the market was able and willing to bear at that point in time. And not willing to go and test the market to see where their value is now. And so we talk about that a lot, which is going out and seeking rejection to test the market. And like our view is this: if you don't have some clients or some prospects saying no or pushing back on your price, you're not charging enough.
That's a good way to put it.
And
I like
it's
that.
It's a weird concept, because you're like, why would I want someone to say no? Because no isn't always a no. It might be a no, it might be a not now, or it might be no at that price. And you're always able to then have a negotiation with someone. It happens in most business deals in the world. Like, actually, $10 million is a bit much, but what about 9.5? And so like in from the insurance perspective, like we have a number of risk specialists currently charging for risk advice upfront, just for the advice process. And the framing of it is it's for that entire journey of understanding all of your insurance needs, taking you through pre-assessments, doing product research, educating you about the importance of, child trauma if you've got young kids, or like whatever it is, and then delivering the advice. You're not just paying for a, 30-page, hopefully not 60-page risk SOA. You're paying for that journey and that process. And there's no question, none at all, that people will happily pay for it. And so value is in the eye of the beholder. And like my view on it is you should allow the client to decide where value sits. And advisors generally have a bit of a discomfort with being perceived as being salespeople. There's nothing wrong with selling. Everyone that's in the business of getting new clients is a salesperson. Doesn't matter whether you're a lawyer, an accountant, financial advisor, and you need to be able to sell. And so if you view sales through the lens of something you do for someone rather than to someone, it changes the dynamic of it. So look, from a risk advice perspective, and don't get me wrong, it's completely fine to do, discounts for, whatever reason here and there, maybe a bit of pro bono advice. But your standard fee model has to allow all of that to happen. And so people should be charging advice fees on risk advice. This is going to be a much harder hurdle to get people over, but I think an implementation fee makes sense, particularly on, more complex advice. And, one of the places I think we need support from the insurers is to push the envelope on increasing the commission rates we currently have. We had a profitable life insurance industry for God knows how long at rates higher than 60/20. It's not that you can't run a profitable insurance market, and we've ended up at a place that's been detrimental to both consumers, advisors, and funnily enough, life insurance companies. And so if we can get a unified voice on increasing those up, we'll have more advisors coming back into the space. Hopefully that's coupled with relaxing of education standards and more new, younger advisors or career changer advisors starting to come and want to join the industry. We can get back to a healthy, profitable, across the board insurance industry and less clients walking around with insufficient or no cover.
Mate, hear ye. That's brilliant. That's awesome. Mate, you mentioned education. Now, Keith, I know, is in the FSC and does a great job behind the scenes and relatively publicly as well. And we've had a big win recently. So firstly, thank you for WT and your contribution towards those changing education standards. What do you think that means for you guys, right? And just for context, I think the changes coming are you have to do a degree. It's no longer a financial planning degree, but it's accounting, business, some sort of commercial related degree. And then you can do a 4-tier course, I think, isn't it?
Yes, I mean, I think that's the direction. So there's essentially broad support across the relevant people, including most importantly Treasury, to support the redesign of the education standards, if you will. So, at the moment, you need to have a relevant degree, of which I think there's like 300 or 400 people a year that do it. And if you just think about it as a parent, like, if your child was 18 and going to go into university, would you want them to do an esoteric degree like a Bachelor of Financial Planning where they've got one potential career path? Or would you rather they went and did something like accounting or commerce or marketing or economics?
Yeah.
Where they can do a whole bunch of different things.
Yep.
Very clear to me what I would want my daughter or my son and future son, who's going to arrive in a couple of months, to
congratulations, mate. Well done. Yeah.
And it's definitely not the fin planning degree. And so, which is unfortunate. Yeah. And so if we can go back to like how I entered the industry, and all the signs point to that happening sooner rather than later, which will be fantastic. We'll be able to go and hire people that have done relevant degrees, small r, small d. So something reasonably relevant to financial planning, economics, finance, accounting, commerce, all that sort of stuff. We will end up being able to hire people en masse and with reasonable level of sort of demand for that role. So, we have a team within our business where we actually hire people to do a PY in our network, and part of what they learn how to do is read and review advice files, and then we're able to give them experience in an advice practice through the wholly owned advice practice we still have, which is the modern day Spring Financial Group. Yeah. And the downside is we have 20 applications. Yeah. And we'll have 10 awesome candidates who are completely unsuitable because they have a Bachelor of Commerce. And so then we end up with a smaller pool and a much lower quality pool. And so we'll just end up with a much larger, high quality pool, advisors and practices that are willing to train and invest in people. We'll just be able to go out and just hire a whole bunch of
That's brilliant.
new aspiring advisors. And
I had no idea, right? Because I've always been worried the change in education standards are great, but you're like, I don't know, the old school AMP Horizons, where's that's gone? But it sounds like you guys have got that.
So not to the same scale. Yeah. So like, don't get me wrong, we will have, half a dozen at any given time. So Keith, open the purse strings a bit more. No, we've got a half a dozen. It's not like what you used to see at the banks and at AMP and things like that, but you will be able to have practices with reasonable scale and resource go and hire people and start to train and develop young advisors, which will be awesome.
And so you as the head office with the scale and whatnot, you've got that framework that you can sort of lend to your advice practices to help grow their advisor numbers. Education, like you said, compliance, training, all of it.
Yeah. So, I mean, we've got a sort of fairly unique model on the monitoring and supervision side where we review advice up front. Which sort of helps with the training and upstream feedback to advisors. Yeah. Particularly the younger and newer ones. So they're learning on a case by case and file by file basis. I think also for us, I mean, our backgrounds, like how we built the Spring business was solely through hiring young people and training them up. Little to no experience in advice. We weren't hiring people that had worked at Commonwealth Bank in the financial planning team for 20 years. Right. Like it was people that had little to no experience. And so as long as you've got the right systems, the right processes, the right educational support for them to learn what to do in that role, it's very easily achievable. So I think we'll be able to bring a lot of value to our network in that regard. And the ones that will benefit the most from it are those that have existing scale and a bit of size and capacity in their business to do it.
Yep. Mate, I'm just going to, you triggered a quick response when you said every file is audited. Now
we've got a list of banned words in our office. Right, licensees one. So Advice Networks is what they are now.
Sorry, yep.
Audits a banned word as well.
Right. Okay. How do I refer to them?
Peer review.
Peer review. All right. Now, a mate of mine, Rod McLean in Oxley's. When Millennium 3, I think when they were going from ANZ to IWF to into WT, I'd had a chat to him about this, and I don't know a huge amount about it, but his statement to me was my initial impression, which was that doesn't sound like a lot of fun, to, oh my gosh, I'm a believer. But so can you just take me through what the actual, what was it again? It's not an audit, it's a
peer review.
Can you take me through the peer review process, please?
Yeah. So look, I mean, it was one of the things that we first identified when we bought Wealth Today, which was there are a lot of unhappy people, both the advisors that were authorized under Wealth Today and the people that worked in the business. And that was not a unique thing to Wealth Today. It was very similar with most of the advice networks that we did due diligence on, and certainly those that we acquired, which was the audit process was horrific. Most people feared it, and it was the root cause of a lot of the restrictions and like rigid processes that advisors had to go through in an advice network when they were the 100% shareholder in their business. Like you weren't actually operating like a business owner. You were being sort of told what you had to do because it was the only way that people knew to apparently manage the risk of something going wrong. And in reality, you don't end up managing much because you look at 3 files out of 50. And so 47, you're just blind. And so you just try and limit the potential pathways for advisors to like accidentally, damage a client or themselves and in turn the licensee. So we basically said, okay, we need to be able to do it, but we need to be able to do it in a way that is not subjective. So no personal opinion, that's not how I would have done it. Or, this is my view on investment philosophies or whatever. In a way that focuses solely on legislative and regulatory requirements and in a way that's quick. So we had a model for all new clients within Spring, which was, and you didn't always hit this because of scheduling and complexity and things like that, but for 80% of the time, you need to be able to come back 14 days after the first appointment when you've done the fact finding and present the advice. And so we said, peer review has to be able to happen in that 14-day window.
Wow. Right.
Still allowing the advisor to be able to do fact finding properly, do product research, figure out the strategy they're going to recommend, brief it to a paraplanner, have the paraplanner write it, send it to us, get peer review done, fix any changes, improve the quality of the file. So if there is any rigorous scrutiny later on by whether it's ASIC or AFCA or someone's lawyer, that the advice is defendable, the file is sound, it has all the information in there that we need to, because a lot of conversations never get written down. I know that happens less now with AI file noting and things like that, but it still happens. And help fix up any potential breaches that might otherwise just happen. Someone didn't do a like-for-like comparison. Like no one lost any limbs or anything, but still it's a reportable issue if you don't fix it. And so the team review about 12,000 advice documents a year. The target and commitment to the advisors is 48-hour turnaround times. And over the last 12 months is about 43 hours on average over that 12,000.
Wow.
Yeah.
Far out. And you're obviously keeping track of every bit of advice that you're giving if you sort of can confirm that 40% of it relates to risk.
And 16% of new client SOAs are risk-only ones,
Far out. Mate, well done. That's absolutely brilliant.
Yeah.
I'm going to guess there's some sort of special AI tool or like...
Funnily enough, there is now, and there has been for 18 months. Importantly, to assist the human reviewers, not to replace them. So every file gets reviewed by the human. What the AI does is it enables a much more granular level of analysis per file without requiring someone to spend 6 hours reading every single page document. And what that ends up doing is it means that we can repurpose some of the time that was previously spent pre-AI and pre-more technology into upstream feedback, coaching and training. And so that helps for the next file and the next file and client outcomes.
So it's starting to learn basically. It's great because you see that from the insurers. They talk about applying AI to the claims, I think initially, and then I think a lot of them are going to move it into the underwriting. So it's good to see a large licensee take the next step and go, right, what is it? How can we take advantage of the technology to make advice easier for our advisors? That's awesome.
Yeah. And, obviously data security and privacy and PII reductions and all that sort of stuff are really important. But we just saw it initially, and Frank Paul is probably the most responsible in our business for leading the charge on getting in early on the opportunities. But for us, it was just a no-brainer to figure out how we could leverage it to benefit the network and ourselves.
And is that that type of technology that's fit for purpose for the, as you said before, the one-man bands versus the corporates? Like, is it something that's able to be rolled out just not ad hoc, but just across the whole spectrum of advisors?
AI or the...
Yeah, the AI learnings, the compliance learnings, and the systems and the process and whatnot. What I'm trying to ask, I guess, is risk advice for the one-man band versus the corporates. Is the process the same?
Right.
What role do you guys play in helping that advice practice grow?
Yeah, so I think it's probably more important for the smaller businesses in terms of managing the risk of making a mistake. And a big part of that is the bigger you are, the more or the greater your ability is to have dedicated resources and people doing one task and one task only. And so if you think about someone who is just doing claims, for example, they're going to have a much higher level of familiarity with the claims process. They're going to have a much higher familiarity with potential product features that might exist within older products that they might have seen before that someone who does 2 or 3 claims a year might never see. And the same applies to advice practices and business processes. You've got 30 staff and you have, dedicated people doing or managing the pre-assessment process. You've got dedicated people doing the product research process. You've got dedicated people doing every individual component. If you're a single advisor that does it all yourself, or, you have an outsourced range of services for, paraplanning here and what have you, it's much harder for you to be across every single aspect in a space like insurance, which is, like, let's face it, really complex and only getting more complex. So, way, way harder than it was 10 years ago, like just on product definitions alone. And so I think the role that we're able to play in reducing the risk of the riskiest transaction, which is, buying and replacing insurance, is massive.
Okay. And that scale and whatnot, that claim specialization, is that something that exists inside your business? So you mentioned before Corbo's doing the underwriting. What about the claims component? Is there something internally in WT?
Doesn't exist at the moment. We have thought about it and spoken about it. It's not something that we offer as a service. I mean, look, I think the whole specialization thing, like, as a general principle, we think is by and large the best model for the future. And that doesn't necessarily mean firms specializing in doing something and that, insurance should only be done by insurance specialists. We think as firms get bigger and they become more resource and more corporatized, it makes sense. And this is what we did when we ran Spring. You have a dedicated risk advisor within a business that might have, 5 or 6, holistic advisors, for example, but rather than each of them also trying to be across superannuation change and Div 296 implications for clients, as well as the difference between agreed value versus old indemnity, new indemnity, like all of these things vary greatly. And so being able to have specialized resources only comes with scale and size. Claims handling, look, I think it's a missed opportunity for a lot of advisors.
Because I know PJ on your group, he's got a
very clear model, which is awesome. And part of it is there's sort of three tiers and 3 options, different prices across them. One of them is largely, if he thinks it's a straightforward claim, maybe it's death as opposed to, TPD or something. Might be, look, just deal with it through the insurer. If you run into any issues or hurdles, come back to me. And then others come down to being more of a time allocation. And so it might be, okay, look, you'll get X amount of hours of claims handling work for free as a part of being, a client of mine, or maybe you charge from hour one or day one or whatever, but it's got to be in time blocks because, TBD claims can go for 18 months and what have you. So I think advisors need to do it more though, and need to be comfortable with charging for it. Like it can't be a service that you view as being as like, you get it for free because I received renewal commission for years. Like that's your obligation to the insurer, so that if someone has a question about their policy, they can call you, not the insurer. And so when it comes to claims, like they're so specialized, like there will be policies that have been in place for 20 years that have features in there. It might be a lump sum upfront benefit on an income protection policy that no one's seen for 20 years. The advisor is the best placed person to have that discussions. We've seen cases where insurers have completely missed it. And if it wasn't for the advisor picking it up, the client would have been, tens of thousands of dollars out of pocket. Not to mention the, 30% charge that most lawyers charge on claims handling. So like we basically sit at two complete different ends of the spectrum. Like they get absolutely, reamed when they go and speak to a lawyer on a TPD claim. And then advisors are out there doing it for free. Like there's got to be somewhere in the middle where the best placed person handles the claim. They charge and are rewarded appropriately and reasonably without feeling like there's an ethical dilemma or issue. Like there's a big difference between going, okay, great, well, we're going to charge 25% because it's lower than 30 and charging a reasonable rate.
No, I'm with you on that, mate. But it sounds like, WT's really like that leadership from Keith and yourself is really coming through in everything that you're giving to your advisors, mate. Absolutely well done, mate. Thank you so much for coming in, mate. It's been an absolute pleasure having a chat.
No worries. Thank you very much for having me.